Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Vince Lanci. Vince is a commodity portfolio manager, professor MBA finance at UConn, and publisher of the Gold Fix newsletter. Vince follows the commodities markets, including oil, gas, gold, silver, energy, bonds, and currencies. We are going to pick his brain and ask the questions that you submitted. Vince, thank you for coming on the show.
Thanks for having me on, Stephen. I appreciate the invite, and I've heard a lot, and I'm happy to be here.
Oh, thank you. The pleasure's all on this side of the table, sir. Go ahead, and this is your first time on the show. Go ahead and tell us your story, how you got into commodities investing, and how that led to where you are today.
Well, the commodity part started in college when I was selling gold bracelets to people that they weren't stolen, but the actual investing part. And I was a bookie back then as well. The actual investing part started. I took a job. I got a job as basically a runner, a floor clerk on Wall Street in the commodity exchange, and from there I got a very deep education in derivatives trading, to the point where I was modeling derivatives work and a very quantitative type of stuff. But what I found as going on, I became a trader. I left the firm. I started my own firm, and then what I found is that from this narrow point of view, you could apply it more broadly. And so I started arbitraging different commodities, different options. And before you know it, I'm a full-blown investment fund manager. And that's what happened.
That's pretty cool. So you were a runner. This was pre-internet when when you actually had to take the paper.
Yeah, it was. I got hired. This is the funny part. I was working at Lehman Brothers, right? And they wanted me as a salesman, so a broker, and I sucked at it. It was like I just could not close a sales deal. I was very analytical, At the time, I was very analysis oriented. And one of my buddies said, you used to be a bookie. I used to run a bookie in college, and you like to gamble and you like to bet. Have you ever considered trading? I'm like, what's trading? Like I didn't know what it was. And so he told me, and then I'm in Philadelphia now, and I find the name of a firm called Cooper Neff, and the owner of the firm is named Richard Cooper, and I ambush him I didn't have a degree at the time. I ambush him in the business bathroom, and I ask him for a job. He calls me into his office. This is right at the verge of Iraqi 1. And at that point, they were hiring warm bodies. So I thought I was going to be hired for a job in Philadelphia, He goes, all right. And he asked me a couple math questions. What's 11 times 23 was one of them, like stupid shit, but stuff to see if I had a fear of numbers. And I answered them, and he goes, all right, when can you start? I go, I can start next week. He goes, fine. You start in New York. And I went, what? So I had to move to New York. I ended up living in Alphabet City, in a one bedroom with two roommates. One of us slept anyway. That's the story of how I got involved in it. And then over time, the company that I worked at through the Iraqi war, I'm on the floor running around, right? I had a day where I cried. I got on a payphone and called my girlfriend back in Philadelphia. I'm like, I can't do this anymore. This is crazy. It was crazy. It was, you remember the scene in Trading Places, right? Where they're screaming. Well, that was the floor I was on. And there were actual, that wasn't a dramatization, but during the Iraqi war, it was like that. I would walk by the trading pit. I was like the kid running around getting people water, that shit. And people were elbow to elbow, and people were above the ground. Like they were lifted off the ground by the people around them. So they're like kind of levitating because they wouldn't move. And so people kept squeezing them, and they just said, fine. And they put their elbows on the other people's shoulder. I mean, it was really like that for about 2 months. And that's when I think I had a nervous breakdown. I survived it. They hired me. And then after they hired me, I was basically a specialty person in oil, right? I was my specialty as a clerk. But then what happened was when I finally got promoted to trader, all the traders were quitting. Apparently they got screwed on their bonuses, right? And so it was like, it was like a major firm, but boutique, but major. And as they were quitting, they were putting me in every ring to liquidate. And so I learned risk because I was liquidating everyone. And I learned particular commodities. So I started in silver. And then I went to gold after Clinton was elected and the guy quit there. And then I went to oil. And then I went to natural gas. And then I even went to sugar for a little bit. And so I'm like, all right, what's my bonus? Like I probably made for them at the time, uh, $500,000 a year, which is not a lot of money by today's standards, but it was huge because I liquidated legacy portfolios that were losing money. So what's my bonus? And my boss, who I idolized as a teacher and as a disciplinarian, as a person who knew his stuff, said $5,000. And I walked out of there and I went, I'm entrepreneurial by nature. I went, you know what? Fuck that. I'm out of here. Excuse my French. So I said, I'm out of here. So I quit like a month later, along with the other 12 traders who I had literally, there was actually called the St. Valentine's Day Massacre. On Valentine's Day, like 12 traders out of 30 quit, which is massive, right? And then so 2 months later, about 6 months later, I quit. Or about a year later, I quit, actually. But it took a long time. So that's how I got involved in this. And then you may or may not know Larry Benedict. He's one of the original market wizards, and he was trying to start a program to bring it together talent. It was a really good idea, but the technology wasn't there at the time, and he was ahead of his time on this. And he calls me up, which is an honor out of the clear blue sky, because I read the book and he was in there, and he's like, "Hey, I'm starting this thing." And I went, "Okay." I'm like, he wants me for derivatives. He goes, "Do you want to work with me?" I'm like, "Yeah, sure." Right. What do you want me to do? Derivatives, options? Like, I'm like an eager kid. He's like, "No, we got one of those." I'm like, to myself, I'm like, "No, you don't. I'm better than whoever that is." Right. This is like, I go, "Oil? Oh no, we got one of those." And like the other person does the oil, they're not as good as me either, but they were technical and I'm not technical. And then I'm like, "Well, what do you want me for?" "Gold." And I'm like, "Yeah, I know gold, but it's easy. Fine, I'll do gold." And so 2 years later, he puts the whole thing on hold, and COVID starts, and I'm like, "All right, I'll keep doing it." So I called it Gold Fix. I started doing broadcasts because everyone was just losing money in Robinhood and all that shit and crypto. And so I started doing these broadcasts in the morning. Of course, that account got banned on Twitter eventually. Why, I don't know. Um, and then I said, I'll just start a podcast newsletter, and that's where we are. In the meantime, between leaving that first trading firm and starting this newsletter, I managed my own money, and then I managed money at a $1 billion hedge fund, and I still manage money for a $1 billion hedge fund and a private account, and profitably. That's it. That's the story. So
That's pretty
yeah,
cool.
I was crying on the whole point is I cried in that job. I cried. Please
I
come and get me.
probably interviewed, I don't know, 500 people at least. I've never heard a story like that. That was a good
Oh
one.
yeah. I cried. I remember everyone was like, "Oh, we're going to kill Saddam." I was like, "Please, I don't care about Saddam." We say, "Let me, I'll go back to being a salesman."
Yeah.
Anyway, that's it. That's one of
Okay, let's get your macro outlook. What is your macro outlook of the precious metals market today?
Okay. Are these questions from your viewers?
Yeah, this one actually no, this one's mine, and then everything after this is from the viewers.
Okay, good. So I'm sorry. So then ask again because I want to address your question specifically.
What is your macro view of the precious metals market today?
Okay. All right. So the short answer is macro precious metals are overbought. Secular precious metals are underbought. And I think it would be better for me to define macro, not to be difficult about it. But for me, macro is drivers that are based on monetary policy, governmental policy, issues like that, right? And so interest rates and dollar correlations and what have you. And I think gold and silver are overbought by those measures, but they have been overbought. Well, gold has been overbought by those measures for a year and a half. you know? So since uh, the Ukraine-Russian war, February 22, seized their assets. They're overbought because everyone's buying them. They're overbought and underowned. So from a macro point of view, just taking that concept and putting it into a time frame, you know, for the next 3 to 6 months, the market seems overbought. Uh, Looking forward, I just don't think, and I'm not diminishing macro. I just think macro has to catch up with the fact that the big picture for precious metals is they're underowned, and so overbought on this scale, but underowned on that. So what are we at? All-time highs in gold with $100, $50 moves the last 2 days back and forth. And you're like, what is that? What is that? That's a market that's overbought, you know, and it's trying to figure out what the hell it wants to do next. But it's not crapping out, at least not yet. And so I say it's underowned. Silver's a different story, though, right? Silver is not overbought, but not getting the love that gold is getting for all the known reasons. So my outlook is for 2025, to give you a quantified answer. For 2025, I think gold finishes higher, although I don't think it finishes higher at the tarred pace that it had last year. With one caveat, there is a kind of global reset going on, not to be conspiratorial about it. And if the global set hits a signpost where more information comes out, you're going to see gold outperform everything, you know, and silver hopefully would outperform gold, but not immediately. And by reset, I mean all the gold coming back to the US, the repatriation, which is on top of the gold being bought by China incessantly for 2 years. So there is a shuffling of positions that will end with gold being a part of the monetary system in a more overt way. And I don't know what happens. That's the outlier. I'm bullish 15%. And if this happens, maybe 50%. It's hard for me to quantify, but that's it.
Okay, so basically, long term, you see, nothing but tailwinds for gold. But in a short kind of small sense, we're overbought. Like if I pull up the charts here, we could just look at RSI in the 70s all day long, right?
Yeah, that type of stuff.
Yeah, but when you look at the big picture, last I saw from the World Gold Council, it was something like 30 or 35 basis points of Americans actually own gold.
Right.
So it's just nothing. No one owns this stuff. It's
overbought.
It's those few people that are buying that are driving it up. Yeah.
That's right. Overbought and underowned. That's right.
Overbought and underowned. I like that. Okay. Lawrence wants to know, he says, what do you believe will be the best performing asset of 2025?
Besides silver and gold? No, I'm lopsided in gold right now. Last year, I was long gold and short bonds as a combination trade, and it just did phenomenally well. And people who look at that, if you're looking at like a chart, you can take GLD and just subtract TLT from it, and you get this phenomenal chart that just ramps up. GLD minus TLT. If you type it in and say TradingView, it'll pull that up. Oh, you have that?
I could make it. Let's see. GLD minus TLT.
Yep, that's all you have to do is just do minus
and then
TLT.
Hit enter. Okay, let's see here. This is a first for me. We'll learn together.
Pull it up like on a monthly.
Okay.
Or weekly. I don't care. There you go. Okay. That is what happens if you're long GLD and short TLT simultaneously.
Oh wow.
And it's amazing, right?
Yeah.
Okay, so the thing is, I put this trade on because when Powell stopped, I mean, it was a home run. Let's be clear about it. Yeah. But it was incredibly risky. This is an incredibly risky trade that just paid off. The idea was when Powell when Powell hiked rates, I said, is inflation done? Right? And I thought no. All right. And so I did not expect this return. And so I said to myself, what are the two ways that inflation can manifest in the markets. And one would be gold goes up, which, by the way, does not happen all the time,
Mhm.
or bonds go down. Doesn't have to be both, you know? So
Mhm.
I bought gold and I sold TLT. I literally did GLD minus TLT and held it for 6 months. And during that 6 month time frame, I held it for over a year and a half. But during one time frame, the SVB banking crisis happened, right? And so bonds
Oh,
really got dumped on, and
yeah.
gold really got bought. And then from there, it was like woof, it just kept going. So when I look at that relationship, I walk now that this trade is off. I come to two conclusions. One is that we are in the middle of a global reset. That's what that is. Like if deflation came back, that thing would crater and I would have gotten killed. And inflation is part of the global reset. But to answer the question as posed, I believe, and this is contrarian. I believe bonds are a buy now. It's even contrarian to my own feel. The point being is that's too steep, and bonds are probably a buy now. And there are really good reasons for that, beyond my own uh, intuitive trading opinion. Like,
I
for
mean, just
example,
like TLT is a buy now, you think, or are you talking something like 7 to 10 year duration, or you just
no, 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 no. You're right. TLT will be the simple way to express it. Don't
okay,
I don't get fancy with those things. Yeah,
okay,
exactly.
yeah, I could see that. You
Steepener.
got a little double bottom right there. Yeah, okay,
Yeah, I mean, that's actually that's a quick assessment. I would not have seen that. Yeah, a double bottom.
yeah,
Now there are
it's not
uh,
perfect, but there's something
no,
there.
but right, but let's see.
Yeah, okay,
The reason for it is again, this is macro, right? So I'm going to be channeling Michael Hartnett, the chief investment strategist at Bank of America, who is one of the best, if not the best, out there right now. And he's a contrarian, and I don't always agree with him, but in this case, he's saying, "Look, bonds are in a secular bear market." And I said, "Yeah, I know that. I called that last year. At least my portfolio did. I got lucky, right?" And he goes, "But," and then he just goes through all this, and he goes, Trump gets elected. I'm already looking to buy bonds. And he goes, Trump gets elected, right? And he knows that the public is just not going to tolerate inflation right now. And so he's looking to cut. This is before he started doing all this stuff. He's looking to cut. He's got to come within budget. Something's going to happen. And in doing these some things, he's probably going to cause a recession, you know?
yeah.
But you fire enough people, you get a recession. You stop immigration, you put maybe some wage pressures on. Maybe you have a stagflationary situation, which is not good for bonds. But then he said, then at some point, stocks will crater from that. He's like looking 1 to 6 months out. He says, when that happens, then the Fed's going to ease. But all during this time, it's like I'm buying bonds because I'm worried about because Trump is cutting expenses, cutting spending, right? And then I'm buying bonds because the recession is starting, and then I'm buying bonds because Powell's going to ease eventually. So I went, yeah, this is the bond trade. So my answer is after gold and silver, which I am biased. Uh, as an asset class, I love bonds as a speculative position for a reversal and rally, ultimately due to a crash in stocks. And I'm not bearish stocks. I'm just saying that's my thing. Trump's frugality, or at least an attempt at frugality, right? Plus a weaker dollar, which will happen eventually. It's happening right now. It's happening right now. The dollar's getting weaker. People are going, tariffs, strong dollar, American exceptionalism. And I'm going, yeah, it's happening. But since Trump actually took office, the dollar's down almost 2%. So we're at the beginning of the end, meaning Trump's tariffs may or may not work. If they work, recession. If they don't work, recession. Like that's. I mean, I'm not a perma bear. I'm just putting it that way. So I like bonds. I like bonds, and I like gold. And so I rationalize it like this: if I'm long gone bonds, if I'm long gold perpetually, and I was short bonds, now I think it's kind of like, what, bonds are a hedge for gold right now, and I want to go back to that traditional relationship. I hope that answers his question.
Yeah, bonds. It sounds like that's it. Do you follow the LQD at all? The corporate bond ETF?
No, but I used to be very well versed in corporate bonds. What should I be?
Well,
What's your take on a ton of money went into corporate bonds this year, and
okay,
yet they
here it
still
is.
haven't moved at all, right? Am I right?
Yeah, basically, I had another guest on the show, David Skrika. I don't know if you know him.
Yeah, yeah,
Yeah, and he kind of liked. He mentioned this in his book, was putting a long dated put option on LQD, and so basically you could see he's expecting some kind of washout, and he's like, the options on these things, if you catch them at the right moment, are super cheap, almost
right,
free. And if you
right,
catch a moment like this, like COVID here, or even one of these smaller moments right here, you know,
right,
these are approaching 10, 20x depending on how quick you're on the trigger.
right.
And so I'm just kind of I'm a TA, so I'm kind of waiting for a moment here, maybe around 110 or maybe a little bit higher. It looks like this is going to keep going up a little bit, but
We're looking. I'm sorry, help me out here. We're looking at a corporate bond index, right? An ETF, I guess.
yes, yeah.
Okay.
Yeah,
All
this is
right.
the weekly time scale, and basically you just run a put on it for like January 2026,
Right.
and if this goes down and does a COVID moment, you make a pile of cash. But meanwhile, the rest of your portfolio, even the gold portfolio, went down as well. So
Yeah.
now
Exactly.
you
Exactly.
make 10x your money here, and then you can double down on Agnico Eagle or something.
Right, right. Well, okay, okay. So just trying to like integrate, like we're on a trading desk here, and
Hmm.
you like corporate bonds, or maybe you don't like corporate bonds, and I like bonds. That's a trade right there. And by that I mean, if you look at, and I'm not sure how to pull it up, but you would look at TLT versus LQD, and that's got to be a spread. Corporate bonds, treasuries are yielding too much relative to corporate bonds right now. That's the way I would put it. So TLT is cheap relative to corporate bonds. If this is again, I'm channeling Heartland again, and
Yeah,
if
yeah.
that's
This is that chart. So I put TLT divided by LQD.
yeah, there you go. So did I call it right? Am I saying it right?
It looks relatively cheap. Yeah.
Yeah, exactly. So people are under, just to put it in English, right? So for myself to make sure I get it right, people are undervaluing the safety of government bonds relative to their corporate counterparts. So, and you could see that we had a banking crisis. Treasuries got hammered, and corporates really were unaffected, right?
Yeah.
During COVID, they both got hammered, which was kind of weird. Treasuries got hammered during that time as well. But now we're in a situation that I think that I see you looking at it like a technical analyst going, oh, maybe there's a trade here. So maybe there's a trend line in there you want to draw. But I think your trade, which is to look to short corporates, and my trade, which is to be long treasuries, I think that's a trade. I think that's a trade right there. Although I don't do corporates in that respect,
Yeah.
but a smarter guy than me, and maybe than you even, has said he has a chart on that. He goes, triple A corporates or double A corporates versus government. He goes, it doesn't make sense. That's what he's saying. It doesn't make sense. So yeah, that's a trade. And by the
Okay.
way, is that I guess how would that manifest? That would manifest with stocks coming off, corporate bonds doing well, and then everyone going, oh crap, corporate bonds are not going to do well either. And then everyone goes into that. So it's kind of like a rolling trade.
Yeah.
That's a
One of the things he
chart.
brought up was that he said, a lot of these corporations just have way too much debt. He said since 2008, like, companies like McDonald's,
Oh
Walmart,
yeah.
like they just have debt out the ears. And he
Huh?
said, if there's a market correction like that, these should get hit pretty good. So, or at least hit on the chart.
I'll add that. I'll add to that that when you zoom out to the secular, to the world is in a, I like to say mercantilist mindset, protectionist. Uh, the BRICS are separating their collateral from the West. Okay, when you put all that together, what you're looking at is the West is deleveraging, right? Definancializing. I'm probably using that word wrong, but if you own a leveraged business in the West and you don't have good cash flow, you're going to suffer. So, for example, what's a leveraged business in the West? that doesn't have good cash flow. An insurance company, maybe they do, depending on who you're talking to. But it's kind of like you want to be building houses, not building financial portfolios. So, to his point, too much debt is too much leverage, and deleveraging is going to be like going back on the gold standard for them. Not necessarily literally, but that's the idea. I think, look at what's happened in London. England is a country that, as much as I love it, doesn't make much. They're not a net exporter, right? And they're the hub of financialization. They're the engineers. Like we talk on New York, the US. No. London is the center of the world for that. And as people have less hedges to do, less futures to do, financialization is in jeopardy. And that means if you're over leveraged, you're going to have a hard time getting financing going forward because no one's going to lend you money.
Yeah, they're going to need a higher interest rate, which means the chart goes down and you make money.
That's the idea, right? That's the idea.
We'll see. We'll see. I still haven't bought it yet. This may be one of those where I just him and haw and try to get the perfect price and then miss the whole thing.
Bought the put?
I haven't bought it yet. No, I'm waiting for it to line up at least what I think is a TA will be a good spot and then find a good price on the option. But
what about, have you ever considered this? I'm just throwing your at you. So you have an idea, you want to express it, you're waiting for the time. That's a frequent problem for me, right? And one of the ways I handle it is I go, all right, I'll do a third now. And I'll do a third if it goes my way, and then I'll do a third, kind of like you're watching the tape, or to your point, let's say you want to buy a put, maybe buy a put spread now, and when the right time comes, you take off the leg that you don't need anymore. I don't know.
Okay.
That's stuff that I do. I do that a lot. So let's say I'm bearish on LQD. I'm like, I'm going to kill myself if I wait too long, But you know what? Let me get something on. Let me pick my strikes, pick my targets. I go, I'm going to do the 30-20 put spread, make it up, right? So I'll buy the 30, sell the 20. It won't cost me as much. I'll do half as many as I do. And if corporates rally, I'll just take off that 20 short, and then I'm long the 30. I don't know just different ways to manage micro risks.
You know what? It's funny you mentioned that. I do this all the time when I'm just buying straight up shares. So like this one, I literally put the orders in yesterday so you can see.
Yeah.
But like this one was the first bet yesterday, $5.40. Next one is $5.50 or $4.50, and then $4.12. And but this is 20% of the bet. This is 30, and this is 50. Like as it gets cheaper, I buy more. My conviction is higher.
Right. Right. No,
I've never thought of doing that with options, though. It's so obvious now that you say it. I never thought of that, but that's exactly what I could do. I could buy my first third position in that today, and then basically as it goes up, like I think it will, then I double down essentially.
For your audience, it's the flip side of how you feel when you've made money. So, for example, I'm long a position, or let's say in this case, I'm short this market, that LQD, and it goes my way. I was taught the moment I call Steve up and say, "Hey, Steve, what do you think?" That's the moment I need to cut my position in half. So the flip side of that is, I'm bearish. What do you think? If you're bearish, what do you think? Put on 25%. See how you feel, and if you feel good, then you're fine. If you feel it's not enough, then it's kind of like you have to have it on to know. And so I will frequently stick your toe in the water. You buy. I'm not telling you what to do. I know you know what you're doing. It's like, what's my risk? Let's say I'm going to risk $10,000 on a trade. I'm making a number up, and let's say that's 10 $1,000 options. All right, I'm going to buy one just so I can feel like intuition is based on observation, and nothing gets your attention like losing money, right?
So true.
That's like, oh, this is not a good idea. It doesn't feel right. Do you still want to go down? That type of stuff.
Okay. This Kaiser has a interesting question here. So I'm not sure if you follow uranium or not, but there seems to be a premium on American uranium companies. I think a lot of it has to do with what's going on with sanctions with Russia and like that.
Right.
But Kaiser's asking, in the mining business, does Vince expect a premium for U.S. gold producers and developers similar to what we see in uranium?
If first of all, I know something about uranium, right? So I've followed. That's one of the things where I don't follow the commodity. I follow the company. So uh, Kamiko, I don't know. I always say the name wrong, but they're like a pure play, and everyone talks about them. And the money on those mining companies, um, I don't know about the mining companies themselves, but on a company like Kamiko, you have vertical integration, and I think the business model for those companies, I believe, this is like a Rick Rule conversation, right? Or James Grant conversation. The business model in those companies is different, and I'll give you an example. Their product can go up aside from what you're talking about with Russia, right? Aside from all that, right? The product can go up a lot in price in response to a need for energy because as a percentage of the cost of energy output, uranium's very small. So I don't care how much the uranium is because my biggest expense is X or Y. Uranium is the most important thing at the core, but it's not it. Whereas gold and silver, specifically silver as an industrial metal, probably a better way to look at silver industrially versus versus uranium. Then if you're looking at silver that way, then I have to say, well, silver's a very expensive component for the things that it goes in. So that's the first big differential for me. And so I'm not an expert in uranium. I'm not going to pretend that I am. The other thing is there's a difference. Look, if this person has money and has made money in uranium, here's what's different about gold and silver. Okay. Good idea. I like it. But here's what's different. The gold and silver miners have a decade or more of financial mismanagement that they're working out of. They also have a decade or more of repression because of various reasons. But the mismanagement it started in the 80s. They made a boatload of money, they Texas hedged, and then they lost money. And as a result of that, they've been digging out of it ever since. And now they're out of it, right? These miners are out of it, and now their costs are going up. I mean, the cost, it's irresponsible, not their fault. It's irresponsible what's happening to the cost of metals. It's almost like, and I'm referring to things, we're all talking about DEI right now and uh, save the planet type stuff. I mean, let's face it, it's mining, right? But beyond that, there are more and more bureaucratic costs. So I think there are big obstacles to mining being like uranium. Now, I'm not dumping on mining. I'm just saying uranium is a very special situation. Uh, I think miners. I mean, speaking about miners, not compared to uranium miners, but just miners purely. I think miners have a couple problems, but the two that they can control, I don't see being controlled yet en masse. And the main one of those two is investors want institutional investors want to see a return of capital. They all have free cash. The good ones have free cash flow now. Take your money and buy your shares back. Invest in yourself, or take your money and increase your dividend or do a one-time dividend. And for the most part, they are not doing that. And from what I just read a report on this by RBC, and for the most part, they're not doing that. And they're not really saying why they're not doing that. They're not responsive. And if they're not saying why they're not doing that, then maybe there's this overseas risk that is not being quantified enough, nationalization by a Ghana mine, stuff like that. So as a result, I think it's really, really hard to be naked long. And by the way, I'm long miners right now. I have a trade on, Steve. I'm long GDX and short AIQ, right? So I'm short an AI index and I'm long GDX. And
Oh,
I got to
that's what
tell
that
you,
AIQ. Okay, I hadn't heard of that.
yeah, well, it's small enough and small enough to really screw me over if the AI goes up. Like tomorrow when Nvidia's earnings come out, if I'm hanging from a tree, you know why. It's not a big position, to be honest. But back to your viewer's question. Um, I think American miners have a legacy of financial difficulty in combination with this ridiculous ramp up in cost that they're dealing with. And by the way, it's a cost. You don't want your mine nationalized, then you got to kick back a little bit more money to someone in Mexico. I mean, that's what they're doing now. And I don't think U.S. policies help them in that respect. But that said, I'm long GDX now, and this is not something I've had for years. I haven't owned miners for 15 years, and I bought them again 2 years ago, and it got out before the last run up. I'm not going to, and I suffer. I bought it when Druckenmiller bought Newmont, and I got out before the big run up. So I'm a scared miner person, so you have to take that in mind. But I don't think uranium is appropriately compared to miners. Maybe if you can find a pure silver play, but I don't think it's a good comparison, unfortunately.
Okay. All right. So different, basically the the American or North American miners had a lot of mismanagement with their money, and they it sounds kind of like borrowed short and lent long or something, or they just did bad debt, and now they finally climbed out of that, but they have this overhanging prejudice, I guess, against them because they messed it up the last time. Are they going to do the same thing this time as everyone?
Which is ridiculous because the good ones have free cash flow. They're making money. They have good operating leverage. They have small financial leverage, clean balance sheets, and they're probably a massive buy. A massive bull market would happen if somebody would take their foot off their throat. I mean, last month, the RBC report I just saw, outflows are continuing in miners as gold's making new highs. It's almost like people are buying gold and selling miners against it. It's almost like somebody's arbitraging them as they don't have any metal anymore. I don't know, but yeah, exactly. They clean their act up, and the marketplace continues to punish them, or they have just bad luck,
Yeah. I've heard the typical leverage is like 3x. Is that kind of the kindergarten method of it? Is if gold goes up $1, the miners should go up $3. Kind of.
Well, yeah, I mean
dollars isn't the right word, but ratio.
Yeah, I mean the people that I talk to about miners, I'm not a miner bug, but they talk about it in juniors versus seniors, right? And so seniors should be 3-to-1 because they have operational leverage. They just turn another digger on or something like that. They just pull more gold out. They have it already, right? The juniors, 3x, 4x, 5x, because they haven't really dug for this silver or gold yet. They found it, and they have financial leverage, and so they should do really well. If you this is a fine point for it that I'm just studying myself. If you go back to COVID, when gold took off and silver took off and the miners took off, one sector really outperformed the other. It was like juniors versus seniors, and I forget. I have to look. I don't really know, but that was the wrong way metal should rally. It was almost like a stimulus rally. So if you're looking at it on a chart, like GDXJ outrageously outperformed GDX during COVID because everyone in their mom's basement was getting stimulus checks and buying juniors.
Okay.
And if you want to have a really good physical a minor rally, it starts with the seniors and it ends with the juniors, and that's the takeaway I've gotten from studying this. So that's it. I mean, that's all I can tell you. So I want to be bullish. I can't be bullish. And by the way, I can't be bullish because I don't know individual miners. You have to know the management.
Yeah.
You have to know what the management's doing.
Okay. Yeah, I just did that while you were pulling it up. I thought I shared my screen, maybe not. GDX went up. If you were psychic and you could hit the bottom and the top, GDX went up 175, 180%. And then GXJ went up over 200. It was 230, I think. So.
Yeah, it was like a meme stock,
Yeah. Yeah. Okay. Nautica has some questions here on when the $50 silver mark. So let me pull up the silver chart here, and we'll just pontificate here for a moment. So I zoom out here on the long-term chart. We'll bring out the monthly, and every silver bug knows, 1980 right here, and then again in 2010, 2011 for a
Right.
hot minute. What do you see with this, Vince? What he's
Okay.
asking, when will we hit silver, $50 silver again?
So we're charting. We're charting right now. I got you. I'm with it. I'm with you on this. All right. So how about this? The first thing that I'm going to say is that $50 silver will be nothing when we get there. It'll be like 2,000 gold. When we got to $2,000, it lingered there for a little bit, and then it just never looked back. 2,000 gold. 2009 was my price level. It stabilized above that, and it never touched it again. So when we hit $50 silver, it'll be support, not resistance. Now, that's easy to say because I'm sitting in this desk and we're not there yet. But I think if $50 gets you $75, I think. Now, I'm not predicting price. I'm just saying that if we get to $50 again, then that's because they've given up repressing it. I do believe silver price is repressed. There's I've worked with traders that did it. Do I think they're repressing it now? No, I really don't think they're intentionally repressing it now. It's just, I think, part of the whole miner thing. Oh, it's silver that's not going to go up and people don't put their money in it. But it's been gaslighted for a long time. So I think if we get to $50, you're talking about $75, and I mean, I don't want to give you a soundbite, I have a feeling about it. Let's just say $35 is our problem right now. Okay,
Yeah.
right? That's a problem, and that's the new. Used to be like $22, above $35, and people better at this than me. Michael Oliver, for example. Let me paraphrase him. Silver's long-term momentum reignited in 22. Period. Its intermediate momentum says that we're in the process of turning up, and a settlement. I'm giving you a real levels here. A settlement over 35.10, give or take. I'm not quoting his number, but it's in that area. 35. It might be his March future. Settlement over 35.10 would reignite us to have all the upside you want. So above 35 gets you 45. That's it. Above 50 gets you 75. And I know it's easy to say that stuff. I can say this with a clear conscience without being a conspiracy theorist. When I traded at a fund, right, $1 billion fund, and I would put gold silver trades on all the time. Why? Because I was bullish gold. And I was bullish gold and I sold silver against it. To manipulate it? No. Because the exchange would allow me to cross margin them and I'd have less money tied up. So if I'm allocated $10 million and I'm putting up and I buy 100 gold, if I sell 50 silver to be maybe volatility neutral, or 100 silver to be notional neutral or margin neutral, what ends up happening is I have a pure play on gold and I'm kind of short the economics against it. So the marketplace encourages you as a fund manager, as a paper player, not just a manipulator, to sell silver, which brings me to why do I think silver would go up? I think it'll be silver based, nothing else. And it's all there. The macro doesn't mean much to me right now because the secular is China is now buying silver at the source. They're buying the raw material. So it doesn't affect the surface price. So the surface is placid, but underneath there are monsters buying all the physical silver that you can get. So technically speaking, I mean, let's look at that technically speaking. Right? Here's what everyone likes to talk about, and I'm going to address it. The 40-year cup and handle.
Okay.
Right, Steve?
Yeah.
Okay, all right.
Yeah.
So I'm not a technician, but I know them. This is going to be a very bullish conversation. Let's start with the facts. That is not a cup and handle. And I'll tell you why it's not. A cup and handle, again, I'm not going to be not bullish. This is going to be very bullish. The handle, the dip can't go below a certain percentage of the right lip of the cup. See how deep that goes?
Yeah, this orange here is 38. That's 50. That's 61.8. So this down here must be in the 80% retracement.
Right.
Yeah.
So we're not looking at a cup and handle. We're looking at a mug and an elephant ear attached to it. And why is that important? I'll tell you why that's important, even though you didn't ask. A cup and handle is a sell-off, a rounding bottom, an orderly climb, and then a healthy pullback, a bull flag. That's all it is. That's all it is. And now I'm going to tell you why this is so beautiful. It's beautiful because forget the 40, forget that, right? I'm not looking at that. But I am looking at this. The formation is, look, we're at the level where we should start running. Okay.
Yeah.
See the move on the right hand side, Steve. You're that last dip, and then we're above it now.
Right here.
It looks like that I'm looking simply at the high of, call it 30 on the left hand side.
Okay.
To the low. What is that? 30 to 16?
Yeah, 17, 18 bucks.
All right, so 18 minus 30, $12, right? So this is very simple, but it's very effective, and it's tied to things like cups and handles. Once you break 30, you add $12.
Yeah.
So the market should be going to 42, no problem. So that's why I say 35 gets you 45, 35 gets you 42. And then from there, you can start looking at it as a cup and handle again. I don't care. It's going to infinity for whatever reason you want, but that's it. I'm just, that's it. Those are my my measurements. And the reason I'm so adamant about the cup and handle is because the cup and handle was my trade in gold. The cup and handle, when it broke in or started to tweak above it in November of 23. I sat down with Jordan
Royburn at the Daily Gold.
Jordan Royburn, the Daily Gold, right? I sat down with him, and we started this monthly thing. At the end of every month, and I would tell him macro flows, and he would do a technical recap, and it was fun. But when the gold cup and handle broke out, it was just a buy, and no one talked about it. Everyone was talking about the silver one. I'm like, no, you just buy the gold one. When the Bitcoin cup and handle broke out, you buy it. We bought it. We bought it. The silver one is not a cup and handle, but I'm not married to that. It's going up. I just don't care what you call it. But it's a different kind of bull flag, and it looks great. So $35.12, right? $35, 35.12 gets you $42, $47 really. So that's it. That's where I am.
Okay.
Oh, by the way, could you stretch it out a little bit?
Yeah.
The other form. No, I mean, the other stretch, to widen it so we can see that right-hand section. I want to zoom in on the right-hand section. Yeah.
All right, I'll go to the weekly here, and that'll.
No, you had the same shape. You had it up there, and it was really what people are talking about that I missed. You have a something like an inverted head and shoulders in here too.
Maybe I
don't think so either, but it's again, it's not a perfect head and shoulders, but it's a powerful signal that a bottom is in. It's powerful.
Yeah. I guess I could kind of where'd my little.
Oh, you're placating me. You don't agree. I don't
that, and then that. Is that what you're talking about? And now it's broken out.
That's not what I'm talking about. Other people are saying it. I'm like, that's not a head and shoulders because the volume doesn't confirm it at those levels, and it's kind of like a scrunched up shoulder. It doesn't really breathe enough. But I'm just looking at it as a simple measured move. That's what I'm doing.
Yeah, I suppose so. Yeah, I would definitely take that as a measured move. As far as like a inverted head and shoulders, so you kind of want it like coming down and then it's a reversal and it goes the other way. So is this enough time to say, yeah, it's going down? I don't know. I don't know. That's where I
Right,
think they're a little
right.
subjective, but no matter how I agree. I don't think that this is a or a cup and handle either. I mean, as far as like what I was taught, it shouldn't go past this orange line, the 38%,
Oh,
and it
really?
can't
Okay.
go past the 50. And we just
Right,
blew
right,
through all of that for
right.
12 years, you know?
I
Like
mean,
it's just not.
exactly. You got a rounding bottom. Hey, would you mind? There's something I want to share with you that I was taught about cup and handles, or more specifically about rounding bottoms.
Uh-huh.
Could you pull up the gold cup part? And
Sure.
I want to show you what I see, what I was told. It's already happened. We know it's already happened.
Okay.
And all right, so yeah, so stretch. Yeah, exactly. That's the area we're talking about. So
Yeah.
we're looking at the cup. Now, this is what I was taught and why I was so convinced when it actually broke.
Yeah.
The One of the characteristics of a cup and handle within the cup is that on the way down from left to right, from left to the bottom, right? So
Mhm.
it's jagged, it's chaotic, and it's a disinvestment cycle. So it's choppy on the way down. It's violent. People are getting hurt. There's dead cat bounces. And then on the way up, it becomes almost like a channel and it gets more orderly.
Hmm.
And the explanation that was given to me back when I was working with a technician, I said, what does that mean? He goes, well, on the way out, it's people getting out. It's exiting, right? On the left-hand side, it's like, choppy getting out. On the way in, at some point, someone decides, whether it be one person or a cohort of people, someone says, it's time to buy it. And you end up getting these nice trend lines for weeks and months. So on the way down, there's no real one single trend line, right?
Yeah.
On the way back up, though, you get a very nice trend line. And I was told that when you see that rounding bottom,
Yeah.
it's basically what it's talking about, it's panic, right? It's kind of like how a bubble ends, right? It's one
Yeah.
side of a bubble, panic, right? Depression, hope, and then collapse, and then it starts off on a very nice rally. That's why I really, really, really liked the gold formation when it finally broke out, because whoever was buying that right side between 2019 and 2021, they meant it,
Yeah.
And when I looked at the silver one, I didn't see that. I saw chaos everywhere. And so it didn't work for me. That's it. So, I mean, have you ever heard anything about that? About the
No,
actual?
talking with Jordan, one thing he taught me was that when the right side of the cup is
Is
higher
higher.
than the left,
Yeah.
that's more
Yeah.
bullish. And like you
Yeah.
couldn't get a more picture perfect cup and handle here. I mean, you have 3 points, one here, August 2020, then you get the war premium in 2022, then another one right here. I think, I don't remember, was this the banking crisis? And then finally when it broke out, and I remember I was selling a few of my gold stocks here. And I remember thinking, like, this is probably stupid. If I did nothing more than just buy breakouts and cup and handle patterns, that would probably be the right thing to do. And of course, it was the wrong thing to do. And it just continued to go. I thought we were going to go for a quadruple top, and I was wrong.
Right, right. Exactly, exactly. And it's like, okay, it's a really long handle, but no, what it is, it's accumulation and pullback.
Yep.
And see those pullbacks? Every
Yeah.
one of those red candles going down,
Yeah.
there were I'm not technicals don't care about fundamentals. I understand that, right? But I saw those pullbacks and I went, why is it happening? The one in 22 happened because the Fed hiked, and that was because, by the way, see that peak right there?
Yeah.
That's the Ukraine war starting.
Yeah. Yeah.
That's the federal government saying, I'm not saying they did it on purpose, but I'm saying the Fed hike started the moment the war started. And that's what got gold and silver in line. I mean, what they weren't thinking about gold and silver, they were thinking about inflation in general, right?
Yeah.
Ukraine, war, you can't get the oil, sanctions, let me raise rates to kill demand. And it hurt silver more than gold, but look at what happened there. It's like, okay, we're going to buy these dips all the way down. And that's when China really started ramping up their purchases.
Yeah.
And so there you go. Triple top, quadruple top. By the way, in precious metals until 3 years ago, there were like septuple tops that never went through. Where's your moving average? Same place it was yesterday. Well, that's where I'm going to sell it every day. You know, there's nothing. But what's it? Sideways is bearish in a bear market. That's what.
Okay, let's go into. I want to talk about the LBMA. I don't know if we'll be able to get to all of these. You got to go in 15 minutes. Okay, let's do the LBMA. That's probably the biggest one on the screen right now. Fiat is dead. Stimming are asking about this. Javier, I'll just read these off. Maybe you can kind of pontificate on it. Do you believe silver will need a stock market crash to take off, or could it rise due to recent LBMA shortages even without a crash? Let's hear the latest updates on the LBMA paper market squeeze. So, what's happening right now with London and their gold and us bringing it over? Like, just kind of go over a 101 on that.
Let me take an asthma inhaler hit before I answer that, because I'm really steeped in that. Whether I'm right or wrong, we don't know. But I just muted myself. I don't want to go down a rabbit hole, but yeah, I can hopefully paint a concise picture. Just give me a second. Okay, so I'm going to start big picture and zoom in and try and give you like a concise thing of what's going on. London is the physical vault for the world in gold and silver, right? So we're talking about gold and silver. If I say one, I mean the other in this conversation. London is the storage place where everybody puts their collateral. The COMEX is an ancillary vault. China, not even a player, right? Until recently. So if you wanted to play any games or you wanted to get access to collateral, you would borrow London. Remember, gold and silver, specifically gold, it's there. All you have to do is borrow it. It's not going to be destroyed. You can borrow it. You can give a rate of return to give a little dividend to the guy. Hey, I'm going to borrow a cup of sugar from you, and you replace it 6 months later. And so that's the London vault. And for the last 2 years, and before that more, but for the last 2 years, China and other BRICS nations, because they're in the process of heavy de-dollarization, and by doing de-dollarization, what they're really doing is they're not anti-dollar. They're basically getting out of their treasuries because they don't want to get their treasuries confiscated as well. So they're replacing a portion of their treasuries with gold and silver, but that's not really going to be the focus of the LBMA, even though silver's worse. All right, so now you have that. So now everyone's saying, I no longer want the promise of gold. I no longer want the promise of silver. I want the actual physical because of confiscation risk. And so over the last 2 years, metal has been coming out of London, going to China. Metal has been coming out of the US, going to London. So it's kind of like you're skipping the pond and then you're going to China. So it was like there's a straw, or a pipeline from China sucking metal through the LBMA, because that's where the physical is. That's where you rely on it. It goes out of London. It goes into Switzerland, gets remarked, gets rebranded. Legitimately, it's like a halfway house, right? And then goes to China, and that's been going on for years, right? And it became much more obvious in 22, and none of the banks discussed that. They saw it, but still they were like dollar correlations. The dollar stronger, gold should go down. That type of stuff. That's the stuff that the mainstream media, or which is really the legacy media now, as well as most of your huckster YouTubers are trying to get in and buy a 401k account, would say. Okay, so that's going on, and we're all oblivious to it. In October of 23, right? This is the beginning of the end of the intro, right? In October of 23, it became apparent to me, and through 2 sources, that we broke this in the US. No one cared about it, but it was right that China took delivery of US gold. And we didn't hear about it again, but it was confirmed. And so now what you have is you have China pulling gold from wherever it can. China pulling silver from wherever it can. All right, so now we fast forward, and that's going on, and it's going up, and no one really cares. And now, LBMA. What is the LBMA? It's physical gold in vaults in London, that's owned by the LBMA members. The LBMA is not an exchange; it's an association. It's a legalized cartel. It's not a cartel, but you get the idea. It's a legalized association that's supposed to help keep an orderly market for physical precious metals, monetary metals, and that's what they do. However, there's kind of like a shared vibe going on there. You're frenemies, you know. I have gold, you have gold. Can I borrow yours? Some guy wants delivery. Yeah, I'll give it back to you next week, and that happens all the time. And I'm being euphemistic about it, but that's kind of what goes on. There's actually a paper gold market in London that nobody knows about. People like Ronan Manley know about it. People like me know about it, and people who understand the bond market and the gold market in London know about it. All right, so now we get right to the crisis. So London's constantly giving gold and silver to China, right? And when they can, they're pulling some from the U.S. to refill their stocks. You know, they're calling their buddies, "Hey, you have any gold that you're pulling out?" And, you know, so they're a little bit stressed, but they're getting it done. And then all of a sudden, the U.S. says we want our gold too, right? Now, the question is, are they buying the gold or are they just repatriating the gold? Well, it's both. But the thing is, my physical gold, let's say I'm JP Morgan, right? We're not going to case them as the bad guy here. I'm JP Morgan and I have gold over in London and I have IOUs in the US, right? That's what the EFP essentially is when you break it down. It's a spread that shows where the gold was and where the gold will be. And I say, you know what? I want my gold back here. Well, why the hell does everybody want their gold back here, right? Tons and tons of gold have come from the LBMA to the US, which creates the LBMA crisis, right? You're now T plus 60, T plus 90 days for delivery. T meaning time is supposed to be T plus 2, right? If you want your metal, we're creating an orderly market. It takes 2 days to get it from the LBMA. Now it takes 60 days plus 2 days. Now it takes I don't know if it's 90 official yet, but it's officially 60. 60 days in addition to the 2 days. So what they've done is they've taken the physical market spot, and they've made it a futures market. It's a 60-day future now, right? Okay. So where's the crisis? The crisis comes from this constant pulling of gold by JP Morgan, by HSBC, by everyone for some reason wants their gold in the US now. I need to have my gold. It's just gold. It doesn't do anything. No, it doesn't matter. I want it back, right? So London is now scrambling to paraphrase them without demeaning them or demonizing them. They're scrambling to keep their supply chains whole to get the gold to people. Really, what's happening is, this is my opinion, is that if the supply chain is a straw, there's air in the straw, right? They've got promises that are coming out not as orange juice through that straw at the other end. It's coming, or gold, it's coming out air. Oh, can't deliver that, can't deliver that. And so I need to borrow, right? So it becomes more of a crisis as who you need to borrow from. Who am I going to borrow from, right? Well, you borrow from central banks. So the Bank of England is now lending. And the Bank of England lends all the time. It happens all the time. But the point is, it's happening so fast, and they're going to tell you that it's heavy. There's a lot of metal. That's bullshit.
Our forklift broke down.
Yeah, exactly.
Jimmy called in sick today. He's the only one that moves the stuff.
Right. There's I don't know where it is. I can't find out, but an LBMA, I guess they're basically just promoters, you know. I walked by and there's a lot of gold and it's really heavy, and I'm like, it's like they're signaling, like, you know, woke signaling or virtue signaling is probably a better way to look at it, to keep the politics out of it. It's like, oh, you know, the gold's, you guys realize it's really hard work we do here. Like, I'm like, shut up, do your job, you know? But I think they're having a hard time keeping their supply chain in order. And it's amazing. It's amazing, Steve, because China's been pulling metal from them for 2 years. They see it. The U.S. starts, they know it's going to happen. And I'll tell you why they know it. And yet it happens. I'll tell you why they know it's going to happen. Because of Basel III. This is my opinion, but in this way, I haven't been wrong yet. This is the first time coming, I'm sure. When Very quickly, Basel III says gold is no longer a tier 3 asset. A tier 3 asset is an asset that if you go to the Fed and you say, I need cash, they'll give you one half of what it's worth. So they'll treat it like it's a piece of art, right? But when you make it tier 1, then I could say, here's my lucky coin, right? Here's my $2,900 ounce of gold, and I go to the Fed window and they lend me $2,900 for it, like a treasury. So it's treated as cash. When Basel III changed after the Euro crisis, when they had remember when silver was over 50 and gold was spiking? That was because of the Euro crisis. Everybody said, whoa, we need to free up some cash. What are we going to do? Well, we can just, let people own their gold again and let people use their gold. Okay, let's do that. And then they finally implement it. So 8 years have gone by and London has seen this coming and they're not ready for it. Now it starts happening in the US. Why is it happening in the US? Because July 1st, 2025, Basel III is a European guideline. The US adopts it. We would adopt it anyway, but the point is that's the deadline. And so if I'm an American bank, and I know the government's going to make me have stricter capital requirements, I need to have more money in my account. I have to have tighter fractional reserve banking rules. And I need more assets. I'm like, well, geez, all that gold over in London, the rules say here, if I have it here, I can give it to the Fed and they'll give me dollar for dollar. And so I think the banks are pulling it back in preparation for Basel I, which is why
Basel I or Basel III?
Basel III. Did I say Basel I? Basel III. Sorry, Basel III. Yeah. I think it's galactically stupid that, I don't really have strong opinions on stuff like this, but I think it's galactically stupid that the LBMA is in this situation, given the telegraphing of years of this happening, which tells me either the LBMA personnel are galactically stupid, meaning they're just bureaucrats who don't understand their own market and they hope it'll go away, or the metal's not available. So the LBMA is, I wouldn't say they're in trouble, but I would say as the rest of the world divides, becomes regional, I want my balls back out of the basket that we all kept our balls in. So kick balls, not those balls, but everybody wants their stuff back, and the basket's being emptied. And the LBMA they've had their finger on the pulse of this for years. So why is it a problem now? I don't know. We saw it happen in China. China had their own withdrawal problems. They fixed it. LBMA's got to be, you got to watch your competition. Anyway, so the LBMA is, I think, to paraphrase Tom Luongo, or I'd say we're good friends and we have many conversations. To paraphrase Tom was like when SOFR, which was like our answer to LIBOR, was introduced for rates. That was kicking a leg out of London as a central market, and the gold market being decentralized out of London is another leg being kicked out. And so I think we're looking at the rise of the U.S. as a gold owner again. That's it. That's the LBMA.
Okay. Okay. So let me see if I can summarize this semi-intelligently. So
Please
LBMA.
Tell me how to summarize that. I don't know how to do that.
I don't either, but I'm going to
What was I talking about?
Got the LBMA. They're the main storage facility, or have been for a while. Then we got the COMEX in the U.S. and the Shanghai Gold Exchange. Those were not very big players until all of a sudden now they start wanting some of their gold back. So a lot of this gold is lent out as, they charge interest on it. And either these people at the LBMA are incompetent, which I guess wouldn't be impossible, or there's a little bit of like maybe they lent out more than they actually had, and they can't fulfill these contracts, and they're trying to give themselves a little window, like, hey, this one is up in 30 days, let's make it 60, and then we can fill this and move that over here. I guess Basel III is set to go into implementation July 1st of this year. And so you're thinking that maybe the U.S. is trying to front run that, and if gold is as good as this dollar, according to Basel III, then all systems go if they can get the gold here before then. Is that about right?
I think you should just cut out everything I said and just say what you said. Yeah, that's it. That's what happened. That's
Okay.
it. You got it. You got it.
All right. So
Absolutely.
it's incompetence or it ain't there. It's
Right, right, right,
overlent.
right. One other soundbite that's actually, if everyone's talking about tariffs,
Mhm.
tariffs are why this is happening in gold. That may have been true, and it may have been a contributing factor, but Luke Roman and I agree on this. It was cover for this other bigger picture thing that's going on. I don't know, monetary reset, a Plaza Accord type of thing, Mar-a-Lago Accord, gold being more important in the monetary system. But tariffs don't make the price of gold go up because gold is money. You don't tax gold, right?
Yeah.
That's the point. You don't tax it. Tariffs make the price of gold go up because if we're using tariffs, then we're a hop, skip, and a jump away from using sanctions, which leads to, if you're Russia, confiscation. Gold goes up because tariffs lead to fear of dollar confiscation. And that's it.
Okay. Okay. Vince, thank you very much. I know you got a heart out. I want to respect that. Any final thoughts? Anything you want to, I should have asked that I didn't?
No. I will say that I think it's really cool that that your viewers generate a lot of the questions. I mean, I think it's very, very, very good, and it was good because you get an idea of what people are really thinking. Thank you for having me on. There's nothing that I'd like to add except I appreciated coming on here, and I think talking to a good technician is fun for me to do because then I could say you're right, and here's why, or I can make up a story. Anyway, that's it. That's it. I agree.
Well, thank you very much, Vince. This was a pleasure. We'll have to have you back on. If viewers want to get a hold of you and follow your work, how can they do so?
The Goldfix newsletter, you can go Goldfix and it'll come up. There's no other word out there for Goldfix, which, by the way, Goldfix is the term that they used to use to fix the price of gold in London. So I'm naming my whole newsletter after the legacy of gold management. So Goldfix on Substack, Goldfix. That's it.
Okay. We will put a link and a plug in the notes below. Vince, thanks again. This was a pleasure.
Thank you for having me, Steve. Good stuff.
Yes, and thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.